And I like how you put that, because there's a lot of different plans out there. But and again, let's make it simple. When it comes down to it, either your life insurance comes with savings or comes without savings, right? So like if I ask you, there's a life insurance that you can have it to the age of 100. It builds up some savings, and you can touch that savings throughout your lifetime. Or there's one that is temporary, 20, 25, 30, 35 years, and you have it, and then it doesn't come with savings. Which one appeals to you more? Just on that sentence.
The saving ones, like, just right away, just the appeals right away.
So this is how I'll explain it. And I'm gonna draw for you guys, but you'll see this, because generally speaking, whenever life insurance comes with savings, this is how it works. Now, there's different types of plans, but it's usually you pay every month. Okay. Part of it's going to go to pay the insurance, and part of it's going to go to build up the savings, right? So part of your premiums. Now, depending on the plan, that depends what happens on the savings. The savings could be an investment. The savings could be fixed. The savings could be tied to the stock market or something like that. Nonetheless, you're paying for insurance and you're paying for some savings, which they call cash value. And generally speaking, they have certain characteristics. Now, the other one, we'll put it just on this side up here, it's just pure insurance. Okay. You pay for it for, like I said, temporary, 20, 25, 30, 35 years. If you pass away within that time frame, the company will pay out. If you don't, you'll have to renew it or just let it go, because maybe you feel like you don't need it later on. So now here's a couple things that we look at. Number one, generally speaking, doing it this way is more expensive. Now, it comes with savings, so they're going to charge you more, because they have two obligations now. Okay. And the way it works is, if you live to the age of 100, so let's use an example.
Okay.
Let's say you have 100,000 of coverage. If you live till 100, they'll give you the 100,000 cash, because your savings will grow to reach 100,000. All right. And if you pass away before the age of 100, they'll leave the $100,000 to your family. Okay. Or really whoever you leave, whoever you want to put. It doesn't have to be family. It could be your best friend if you like them that much. Beneficiaries could be anybody. But now, number one, generally speaking, it's more expensive this way than doing it as a term policy, right? Number two, imagine you're paying whatever a month, right? $100 a month or whatever it may be. 2 years later, you go to your agent and you say, hey, I've been paying $100 a month. It's been over $2,000 now in 2 years. I just want like $500. I need new tires for the winter or whatever it may be. I need to go get an upgraded monitor for my computer. They'll say, oh, you know what, Demilola, thank you for paying. Your policy is active, but you know what? There's no money in there yet, right? How would you feel?
I'll feel really upset, because I'm putting money into something that you told me money will be in there.
Yeah, and what they'll tell you is, it takes 2 to 4 years. Generally speaking, if anybody looks at these policies, they'll take several years to build up any savings. The reason why is there is a charge for trying to access your money early. Okay, they call it a surrender charge. Nonetheless, let's say you say, wait, you know what? Forget it. I'm not going to deal with that. I'll get the money elsewhere. Right? Let's say you go pay for years later, 10 years in, and maybe you have $5,000 in there, let's say. Maybe more. Who knows? Okay. 10,000. But just for illustrative purposes. And you say, hey, I want to grab, $3,000. I want to do the best vacation for my mom. It's her ex birthday. We're going to do it big for her, right? And they say, no problem, Demilola. Thank you for waiting. Here is your money, but please, you got to pay me back the money plus interest, right? How would you
does the interest go to the premium, or does it go to, what does the interest go to?
It goes to pay back that policy loan. So, because here's the thing, your savings can never go to zero. Otherwise, you cancel your policy.
Okay.
And if your loan value becomes bigger than your actual cash value that you had, that's also an issue that can cause your policy to lapse.
Okay.
So, does it ever make sense to borrow your own money?
No.
Well, not everybody wants, but here, some people, okay, you know what? At least it's till the age of 100. I'm going to leave something behind for my family. I'm going to be okay. So now imagine 30 years later, right? You got, let's say 40,000 in there. You've been paying it nonstop, never touched it, no loans. You know, God calls you, says, hey, we need you up here, right? You've done well. And then if you have 100,000 of life insurance and you have 40,000 of savings in that, of cash value, how much would you want your family to get?
I want to get all of it, the whole 140K.
Well, yeah, I mean, you literally been putting your money in there to build up that savings. And what'll happen is they'll pay out. Okay, they will pay out the 100,000 of your family, but they're gonna keep the 40,000.
Wow.
Right.
There's nothing I can do to get that 40K. No type.
Well, you can borrow it, but here's the thing: any money that you borrow from any of your own money that you borrow, they will subtract it plus interest, usually 4 to 8% interest on that loan. They'll subtract it from the death benefit for your family. So some people say, you know what? Well, that doesn't sound so fun. I mean, literally, and you're going to pay for two things. You're only going to get one. In the most essential form, there's different types of policies that promise you that you could take both with you if you pass away. Normally, there's more fees involved with those. And we could look at case-by-case scenarios, which is very interesting to look at. I mean, we could be 90 years old, right? When it comes to whole life policies, you know, we could be 90 years old. We can have, all right, $90,000 saved in there. Okay, not even, let's say we're 90,000. If we pass away, the company will still pay the 100 and they'll keep our 90. So does the company ever fully pay out of our own pocket? Out of their own pocket?
No,
right?
Not really.
Not really. And the longer we hold this, the more they pay from what we've put in than what they've had to pay. And what's the alternative? Because most people don't like this. And this is when you say sometimes, when you ask me the question, why do some people not have it? Sometimes people had this stuff and they go and they call a couple years, like, hey, I want to get some money for my daughter's birthday. Oh, there's no money in there. They get upset, right? They go access their money and they say, hey, I want to get some money. And the agent says, oh, yeah, just make sure you pay it back. And people go, what? I need to pay back my money? So they get upset. Sometimes they cancel this thing. They say, life insurance is a ripoff. I don't want to hear nothing about it. Sometimes that does happen, okay? Now, what's the alternative? What we show people is with term insurance, what happens? You can get a policy for a fraction of the cost. Okay, a fraction. It could be 1/5 of the cost, 1/3 of the cost. You know, if sometimes whole life is $100, then term insurance is $25, something like that. So it's cheaper. But what's the advantage? If you have that muscle to flex, $100, let's say, invest the difference, because you could get the same coverage for cheaper. And the money that we save by doing it with the term, you can invest it or put it into something else that will give you a bigger rate of return than the life insurance, the permanent policies that you see on the left side.
Yeah.
So you might have your money, your 100,000 already built up quicker in 20, 25, 30 years than waiting until the age of 100 anyway. So if the goal was to build up your money and leave something behind, you can do it the other way as well. Okay. Now, you know, there was another point I wanted to say, but that's the gist of cash value life insurance versus term insurance. Term insurance by itself might not be enough. You definitely want to save. We like the savings part of the whole life. The issue is you don't see your money right away. You got to borrow it if you want it, and the company keeps it. That's and nobody wants to pay for something that, you know, is supposedly theirs, but they never get.
Interesting.